Investing in penny stocks for beginners. Penny stocks are securities that are traded on the cheap. The SEC defines any stock that is less than $5 per share as a penny stock. They're sometimes called over-the-counter (OTC) stocks, though some do trade on stock exchanges, or referred to by the size of the capitalization of the companies that issue them: small cap, micro cap, or nano cap stocks. How to invest in penny stocks. 1. Decide how much you're willing to risk. Most people benefit from a diversified portfolio that limits risk. Penny stocks can be part of one, but it's usually wise to balance them out with cash or super low-risk investments, like U.S. Treasuries. Use your mad money for penny stocks, not your nest egg. 2. Open an account with a reputable broker. Look for brokers that follow all the SEC regulations and that provide you with current financial information for any company they recommend. Also, look for brokers that charge an upfront, flat transaction fee, commission, rather than on a per-share basis. If you're not sure where to start, try one of these best online brokerages for beginners. 3. Consider larger exchanges. Look for companies listed on bigger stock exchanges, like the New York Stock Exchange, NYSE and the NASDAQ, because they've met these entities' relatively strict requirements for listings, such as shares need to be consistently priced at a minimum of 1 pair. Among over-the-counter marketplaces, the OTC Bulletin Board and the OTC Link LLC are also good choices. The other OTC exchanges, like the OTCQX and the OTCQB, have fewer requirements and attract less legitimate companies. Steer clear of them. 4. Do your research. To avoid scams, Asher Ragovi, Chief Investment Officer at Magnafina LLC, emphasizes the importance of thoroughly researching the companies you're interested in. Due diligence is especially vital if you're trading on your own through a platform like Robinhood, which is particularly popular with the penny crowd. It limits its offerings to NYSE and NASDAQ-listed stocks, by the way. 5. Critically evaluate your source of info. The most credible information on a company will come from SEC filings, or an analyst report published by a reputable brokerage, investment firm, or independent financial research firm. Be skeptical of any unsolicited contact, like cold emails or telemarketing calls. Similarly, don't trust stock picks and recommendations from sponsored content you see published on the web.